Please welcome the panel on private credit, innovation, strategy, and distressed debt in a maturing market, moderated by CEO of Kaya, John L. Bowman.
Well, good morning, everybody. Thanks for joining. As the voice of God said, I'm John Bowman, CEO of the Kaya Association. For those that you don't know, we're the professional body for the alternatives industry, and our mission is to build the most energized community of investment professionals around the world. So, again, I'm so thankful to Milken and all of you for having me to be your Sherpa for the next 59 minutes. So John Gray and Mark Rowan, I caught up with them in the speaker ready room, and they promised all of you they would be dry and wooden. So you're in the right room. This will be the much better. When I first saw that we're competing with that, I was a bit nervous, but I can assure you this will be a better panel. So I hope we're not videoing this. So welcome, all of you. We're here to talk about private credit, of course. On Kaya's numbers, private credit is approaching about $3 trillion US. That's $3 trillion of $25 trillion that we typically define as alternatives. That's tradable hedge strategies and all forms and flavors of private capital. So it has become a significant piece of the pie. I'd also say, and I think even amongst this panel, there might be a little bit of difference of agreement in kind of how we got here, which is where we're going to start. There's a lot of lore, a lot of mythology, and even some tension around, is this new? Is this old? Well, the activity is not new, but kind of the institutional, I would say, reputation of the asset class is a newer thing, and it's facing its first, maybe, cycle, and I think trying to weather and find itself, kind of this gangly adolescence, working its way through the first cycle. So that is what we're going to talk about today. So I want to start, as I said, Rudy, with a little bit of a retrospective, because I want to frame, before we get to tariffs and geopolitics, which is going to be the source of much of the discussion these next few days, I want to frame the discussion first, because I think that's important to ground everyone. So let's talk a little bit about how we got here. The pre-GFC, this was largely a financing appendage buried in the sponsorship deals of private equity, and it has become, as I said, an entire book in most allocators' portfolio now. So what were those inflection points, those catalysts over the last 10 to 15 years that brought us to where we are today?
Sure, I really appreciate it. Thanks, Sean, for the introduction. You gave me a little bit of a horrific flashback to my high school years. Gangly adolescent, how do we get here? Talks about breaking up just keep coming back into my mind like an irrational ex-girlfriend.
You had a lot of breakups in high school.
Not as many as I would have liked, unfortunately, but that's okay.
You got to get dates first.
Yeah, exactly. Joe knows that didn't happen at the beginning, so, again, it's a little bit of a trauma here, but we could talk about that afterwards. In order to really understand what's going on in the marketplace, we have to start with one thing that didn't happen with my high school breakups, which is you have to assume that all participants in the market are rational. So let's start there and think about what's going on from the individual participant's perspective. Now, rational to you might be different than rational to me because of the perspective that you have, the experiences that you have and where you sit, relative to the experiences that I have and what I've seen before in the marketplace. So let's go back over the last few years. And 10 to 15 years is probably a bit too long of a period of time to see what's gone on, because what we've seen is effectively a slow-growing market that wasn't really moving much until about 3 to 4 years ago when things rapidly inflected up. And so what's happened in the last 3 to 4 years that's caused this change in the marketplace? Again, let's start with the supposition that we have people who are rational actors in the industry. When you have an investment that you make into a business, either as a founder or as a sponsor or as some third-party participant, you fundamentally are optimistic and you're betting that the business is going to do well. You don't want to step in the majority of cases, and have a business that doesn't perform. So if you're in that mindset, you will do whatever it takes to preserve the value of the business, even if things go sideways. Looking at what's happened in the country over the last 5 or 6 years, we had COVID, we had a rapid interest rate rise, we've had massive shifts in the market, we had a new president come into power, we've had talk about tariffs, and the volatility that's in the marketplace has created a dynamic that pushes people to a more rational and aligned set of actors. Previously, where the market would get satisfied for its lending needs would be in the BSL market, which has flatlined over the last 4 years. From 2021 until now, what we're seeing is that that market has stayed flat at approximately 1.5 trillion. Part and parcel with that, you have CLOs who are taking up approximately 70 to 80% of the issuances there. So you now have a fragmented group of owners who are fundamentally counting on liquidity as their exit mechanism if things go wrong. What we saw in March of 2020 is that when things went wrong, when the markets were going sideways, those individual participants were incapable of getting out at an appropriate valuation. We saw Japanese banks getting out of AAA positions at 82 cents on the dollar, which doesn't make sense when you go through a AAA portfolio and you look at what the return profile has been historically. So when you think about these rational actors, they were high in the capital stack, they thought they had liquidity, and when they needed it, they got hit with a massive discount relative to the underlying portfolio. That doesn't work. The equity participants in those businesses that needed a lender group that worked with them couldn't get in touch with the vast group of people that they needed to talk to get to a resolution. And so what happens? Businesses that are worthwhile, that could survive, did not survive because lender groups had different motivations from the underlying owners of the business. And thus, we come to where we are today, which is private credit in the corporate setting, where you have 4 to 5 lenders who work together with a sponsor or a founder. They pay a little bit more, but the certainty that they get is that if something goes wrong, now in the last 6 years, we've seen 3 specific crises that have whipsawed the market up and down. If something goes wrong in the future, they can preserve value for their underlying business by working with lenders who are equally aligned to get to an appropriate outcome. That's exactly the approach we take with our private credit investment, is we want to be partners to see the businesses survive and thrive, not to take them over and have them run into the ground.
Paul, we're going to talk about how you've been a glutton for punishment your whole life and kind of have been a magnet for crises, but let's leave the pre-GFC for a little bit later. You, as I recall, started Orchard Global literally like on the eve of the GFC, and I have to imagine your insight with your partners in the kitchen or the living room when you were thinking up this story took a very different path over the last 12 years. How have you thought about this evolving? What have you seen change?
Well, I agree with Rudy's acceleration point. And I was, before I did all this asset management stuff, I studied, I actually went to school in Florence and studied the Renaissance and the pre-Renaissance. So let's just agree that the Renaissance happened 3 or 4 years ago. But to your point, John, the pre-Renaissance really was, it really wasn't in the kitchen, it was on the trading floors. When we were sitting there in '07, and we said, wait a second, there is a big financial crisis coming. We know it's gonna happen, we don't know exactly when. And for us, the pre-Renaissance to the kind of explosion of private credit, and I'd say private assets, was really in '07. When we said, wait a second, going back to my time at the Federal Reserve, 2 or 3 crises before, we have a solution to the banking crisis that the banking system doesn't yet realize it has on its hands. So I think, yes, the acceleration happened 3 or 4 years ago, but necessary kind of pre-Renaissance things were happening, which really gets back to your rational actor. If, for understandable reasons, the regulator said, wait a second, banks have become too much like leveraged kind of casino bets. We are, and they're still, believe it or not, I still have regulator friends, and they said, look, we know we are going to overregulate for the next X number of years, especially in Europe, but we feel like this is what we need to do. So rational actors, this is a rational response. Trust me, I would have loved for it to take off in the 3 or 4 or 5 years right after. There was some talk about reflective times in the kitchen with the partners. We had the idea in '07, we put it into place in '08. We were vindicated that the crisis happened, so credit opportunity. But '09, 10, 11 is a little bit like, Mike Milken came up with the idea for junk bonds, and it took him, I think, he was here, we could check, he was in the ready room, but it was 9 years of presentations before somebody said yes. So, but let's not forget that the Renaissance 3 or 4 years ago couldn't have happened without the pre-Renaissance.
Yeah. Well, speaking of the origin of the Renaissance, Michaela, maybe help us with Europe a bit here, UK and broader Europe. When we think about the proliferation of products, the regulatory liberalization, some of the investor appetite, these kind of foundational pieces of what makes a market take off. How would you compare? Help us talk through the differences on where we are.
Yeah, so I think the disintermediation in Europe was a lot slower than in the US, and I think is still slower, so there's still a lot of opportunity to grow the private credit in Europe. And I think we will be talking also about the role of the bank in facilitating the disintermediation and becoming almost partner of asset manager investors in order to unlock some of these opportunities. I come from the UK pension and retirement solution side of things. There is a lot of focus for us today on how we actually unlock some of our pension capital into private asset and productive asset in order to ensure some higher return for pensioners. So compared to the big 7 countries, including Canada, US, Australia, the allocation to alternatives and private market, not just private credit in the UK, has been historically much lower. So we are talking about 20% in the mega 7 versus 14% according to certain studies, according to other studies, even lower than that. We are talking about single digit for UK pension plan. So when we look at our balance sheet, we have 2 big opportunities. One is on the pension, defined contribution pension scheme, and there's a current pension review ongoing to unlock the ability for us to provide customer products in the private, as part of your as part of the choice of your pension, having private product as part of your choice. And also on the 45 billion that we have, our shareholder funds, or funds that basically asset that back our long-term liabilities in the defined pension scheme, their private credit has already been playing quite a big role. So if you talk about our balance sheet, is 45 billion pounds asset on risk balance sheet, of which about 10 billion is private credit, and is growing to 3 to 5 billion pounds per year. And why? Because we have long-term liabilities that sometimes you cannot match on public market, and the private asset really provide a diversification, but also it's really helping us in matching those long-term liabilities. And in terms of new products, talking about regulatory reform, the latest, so we are Solvency II bound, so the latest Solvency II reform that enables us to look at potential high predictable cash flow, unlock more than the traditional type of assets such as infrastructure, real estate, social housing, those real asset driven type of private assets, as well as private credit, but also starting to look at securitization that historically was not an asset class that was kind of friendly to insurance balance sheet.
And you talked a little bit, Michaela, about some of the segments that have developed, the sub-strategies, Joe. And we had a really interesting discussion in the prep meeting about, you talked with some emphasis about the importance of kind of calibrating, finding that optimal right down the fairway approach as far as size, because too big doesn't allow you to be nimble, in your words, and too small, you lose control. You're just part of this huge syndication, and you lose your ability to kind of control. How should we think about the different segments and where you think the optimal places to operate are within them?
Yeah, sure, and it ties into all the capital that's been raised, and that's obviously been a big headline for the last few years. If I'm a deal guy, so if you take it back to a deal, 2016, Click Software, Thoma Bravo was buying the company, banks were sideways, couldn't figure out the financing, private credit had to step up. $1 billion deal, if not the first, one of the first. It took like 5 of us, maybe another one, kind of shaking the couch cushions to make that deal happen, right? I think Ares led it and put in like 200, right? And so we all had to lock arms and make that deal happen. You fast forward to today, it's not that much, 8 years later, 9 years later, I think everyone in that syndicate, maybe absent us, could do that deal in a heartbeat by themselves. And frankly, could do multiples of that by themselves. So and by the way, Blue Owl, Owl Rock at the time, I think it just hung the shingle. They weren't even in the conversation, right? Like that's how far we've come in such a short period of time. So you put in that context, there's a handful of guys who've raised most of the capital, right, managing 50, 75, 100 billion plus. And I think at the upper end of the market, they've created a new market. I think it's BSL plus, broadly syndicated loan plus. It's a little different. They get a lot better access to information, maybe a slight pricing premium. But in order to feed all those pockets of capital, they need to go compete directly with broadly syndicated. Versus in my 20 years doing private credit at Guggenheim, our view has always been the second you feel like you're competing with broadly syndicated, you've lost, right? You're giving up liquidity, you should be getting something for that. You should get price, you should get structure. You should get documentation, primarily. So you have the upper end of the markets raise vast sums of capital, kind of created a new market. In the lower end, you've got a lot of new funds, right? Lots made of the new funds. The new funds, I mean, if you're managing 500, a billion, $1.5 billion, $2 billion, those are big numbers, but not in the context of trying to do a multi-$100 million deal, right? If you're gonna do private credit, you want to control your destiny, you want to lead the deals. And so those folks can't lead the deals. They have to buy pieces of other people's deals, and they're along for the ride in a lot of ways. And there's an adverse selection problem. So you think upper end of the market's created a new market. You don't really see that if you're trying to do what I'd call traditional private credit, trying to find relative value. Lower end of the market's kind of buying, or lower end of the fund size is just buying pieces. And in the middle, there's a handful of us trying to actually price risk, get paid a premium, and find situations where it's not just capital versus capital, because when that happens, it's just straight commoditization, right? You have to find other reasons that companies need your capital, timing, complexity, non-sponsor, non-private equity sponsor-based companies. So there's other ways you can actually provide value and get paid for that. And in markets like the last year, broadly syndicated markets functioning, it's harder to find deals across the spectrum, but they're still there. There's still billions of dollars getting done, every week, every month in kind of high quality, non-commoditized credit. It just takes a little more work to find it.
Yeah, and I would definitely want to get back to the current velocity of the sourcing and underwriting in a few moments. But Paul, I think I mentioned lore and mythology at the beginning in my opening statements, and I think one of those pieces has been this idea that after Dodd-Frank and Basel, that the banks kind of completely went away to the desert and never stopped lending completely. And obviously there were ratios and new regulations that they had to abide by, but the reality is they just had to remove it from their balance sheet and disintermediate themselves. But they clearly, understandably, still want to own the relationship, still want to do some of the sourcing. First of all, was that immediate? Or has that been progressive, that they've kind of inched their way back in the party? And how does that symbiotic relationship work?
Well, sticking with the European and medieval themes here, not to get too Game of Thrones, but I think it's an excellent question to ask right now, and it really maybe addresses one of the issues that you bring up: too big, too small, whatever. When we founded Orchard, again as one of the solutions to the financial crisis in '07. That began as I said, a Game of Thrones like war between the asset management community said in the pre-Renaissance, banks can't lend anymore because of overregulation. Don't worry, we, the asset management community, will push the banks out of the way and disintermediate the banks. Okay, we don't agree with that. We said, hold on, as you said, banks do lending well. They originate well, they service well, they have a local branch network, they really know their customers. When you get into a default, they know how to do workouts well, they have a workout department. They just, because of the regulatory changes, aren't necessarily the best place to hold all the capital. So we at Orchard are the anti-disintermediators. And that takes on, there's a couple of advantages there. One of them, though, is what you said. You don't want to be putting $100 billion to work. Or, I mean, you can, but you're not going to be nimble and you're not going to get the superior risk-adjusted returns. Having said that, you want to be big enough to, call the shots, have ideally a majority of the deal, if not all the deal, but at least have negative control, and that usually means you have to have 30 or 40% of the deal. So we don't see this as a either or. But we see it rather, what we do is we work with banks take our nimbleness, we're roughly a $10 billion asset manager, team up with this, that, or the other bank, and then together we can get the best of both. And I am glad, I don't know how many of you were in the International Ballroom just about an hour ago, but my former classmate and now the CEO of Citibank, Jen Fraser, I was really glad that she put an advertisement for working with asset managers together. So I think the answer is the pendulum, after the global financial crisis went too far to where banks were doing nothing, and I think even the almighty Citibank is coming back and realizing that teaming up with asset managers, which each one bringing to the table the unique skill sets they have, is probably getting to that happy medium that you were sort of articulating.
Yeah, I mean, listen, they lend to the private credit market. There are definitely all the headlines of like bank partnerships and trying to get back into actually doing loans again. When you get out of the commercial bank, where they're still somewhat, they're relevant up to a certain size, and then they're an interesting source of deal flow. But the deals I've seen them go out and win in the private credit landscape, they've done what banks do. They underpriced and overlevered. So I know how they win. That's how they've always won.
So I just want to add one thing to what you said, Paul. So what you're hitting on is exactly the way we look at the world, which is you either have liquidity or control. And what we've discovered through the last couple of hiccups in the marketplace is in this market, there is no liquidity. So you have to be in a controlling position to protect around the things that go sideways, because it's a when, not an if, that you're going to have a default, and it's all about your recovery rates. And if you're in a position where you can determine what happens with the business, your recovery rates are going to be fantastic.
Well, and the starting document is paramount in that. That's when you start making the comparison to broadly syndicated loans. I think private credit, I don't care who you are in the spectrum, so long as your doc is reasonable, you see us through the next cycle, and private credit's going to massively outperform broadly syndicated, in my opinion, because you're already seeing it in broadly syndicated. Recovery rates are not what they used to be. And you can't just sit there anymore and say, okay, we're 5 times into this. We think the sponsor says it's worth 10. We think it's worth 7. Worst case, we're covered. Not true necessarily, based on what the document allows, right? So you don't know where you're going to end yet in those deals, whereas private credit, by and large, those documents are well protected, and you don't have all the nastiness that's happened in the broadly syndicated.
It's like we worked together before, Joe.
Could I add just we're talking about, the credit markets here, and some of the sort of maybe bid-ask spread between John and myself is, let's define what we're talking about, because here is where, and this is one of our big focuses as well at Orchard, there's a difference between the US market and the European market. And I think in the US market, there's more of what you're talking about. There has been, post-Brexit, so much dislocation and so much deglobalization, which has probably been accelerated in the last 4 or 5 weeks, that in the European market, I think there's probably more spaces to do that, banks and asset managers teaming up, because you don't have this big BSL market to compete with, or this big BDC market to compete with. So I do think when we ask ourselves that question, we should ask a different question in the US than in Europe. I think that's an important.
So if you were taking Jane Fraser's advice and putting your own instruction booklet on the conditions for a great relationship with the bank,
yeah,
what would be some of those pieces of advice? And I'd love to hear from the others too, who I think expressed a little bit of some disclaimers on this idea.
Well, and that drives, it's funny, Orchard Global, we set it up this way, is truly global. And there were times when you want to allocate most of your capital, actually for a while in Asia, right after the global financial crisis where that was stronger. And then, in 2011 to 14, you probably wanted to be in the US because there's the European sovereign crisis. But absolutely, we see, we're finding 60, 70, 80% of our capital going into Europe because of that handbook. Here's when, not only do you not want to team up with the bank, you don't necessarily want to lend, but when you have the big, Apollo's been mentioned a lot, and Blackstone, and the big players rushing into putting their hundreds of billions of dollars to work, when there's SPACs happening all over the place, when there's ETFs being created, when there's BDCs being created, that's probably not the best place. So where in your handbook, dislocated markets, Europe, you can blame the British for it, ever since Brexit and some of the other forces, Europe is a big, bold, dislocated market. It's going deglobalized. So the more people that are lost in the desert, well, having that bank with that local relationship, that's when they don't do what you said. They don't just sort of rush in and try to outcompete with those other capital markets forces. So the smaller the capital markets alternative is, the larger opportunity for a bank working with a trusted partner asset manager. So I think that should be the headline of the handbook. And then just to peel back the onion a little bit more, if you can have borrowers that will pay up for services that banks provide, like a German middle-sized company that's never had a revolving credit facility before. Well, asset managers don't like revolving credit facilities. So if we can team up with the bank and they can do the revolving credit facility, and that allows us to say, hey, since we're bringing this bank to you and getting this revolving credit facility for you, why don't you go ahead and pay us a couple 50 or 100 basis points extra on the term loan? Those are the types of things that take big talk about partnership and bring it down to the working operating level that generates better returns for our investors.
So if I could just add one thing to that. Working with banks, I think, is an interesting way for a lot of people at the upper end of the spectrum to generate flow. As Joe alluded to earlier, there are these mega funds that are out there that have raised inordinate amounts of capital. And what we need to do is really think about the incentives associated with those funds relative to the banks. We speak on behalf of insurance company capital, and we're in the storage business. Banks are in the moving business. Those other asset managers that are raising significant amounts of capital are also in the moving business. They want to see as many deals get done as possible, and they want to participate in as many of them as possible. We're taking a best ideas approach where we want to make sure that we're going to hold on to that position for the long term, and so we have to be a little bit more selective. And that's where the misalignment of incentives can pop up between asset managers and banks, who, as Joe said, will want to show up, put more leverage on, underprice the position, and try to get somebody to hold on to the paper, pricing to that last marginal dollar. From our perspective, we have to price to the appropriate risk level that's associated with the business and how that moves relative to our cost of capital. And that's where you're going to see a little bit of a divergence where Apollo works with Citi, Blue Owl probably has a partnership with somebody else. They're all out there with somebody special that they want to work with, and we haven't found that somebody special yet. Goes back to my high school days, as you said earlier, Joe. So,
you can't get over these breakups, can you?
I didn't have enough girlfriends to have breakups, so we just keep coming back to the same theme over and over again.
Yeah.
Maybe it's like as an asset owner and an asset allocator, I think all of the options are good, and there's not one size fits all. So when you look, I think it's critical to maintain strategic partnership in private market and leverage on all their experience depending on where their strengths lies. And there will be deals that for the size and the type, you can go solo and have the 100% of the deal or partner with another investor, but still maintaining control of the deal. There will be others where syndicating makes sense because of the size of the deal. There will be others where you partner with the bank because they have the relationship with the with the borrower. So I think from an asset allocator perspective, particularly, we are relative value-based, we are fairly sector agnostic, is really trying to find the best opportunity. And also, we have developed a lot of skills and capability to ensure we understand the credit risk that we are underwriting. So for us, it's very important to understand the credit risk, to understand the structure, to have the, as my fellow panelists talk about, having protection for the downside. So the covenant for us are very important, and more often than not on syndicated or bigger size, you may lose because you require more covenant than other investors. And of course, it's a very competitive market. So what we feel is that more often than not, we also lose on prices. Our additional challenge is that we have mainly sterling liabilities. We have only sterling liabilities, particularly on the defined benefit pension side of things. So we want to diversify outside the UK. The big elephant in the room for us is the cross-currency swap. So because everything we do, we need to, turn it, swap it back into sterling because we don't take currency risk. We don't think the currency risk is a risk that is rewarded enough for the business that we run. So for us, opportunities also are unfortunately sometimes constrained by the cross-currency and the volatility in the market. But
So,
I just wanted to add one thing. Because I take your guys' point on banks, when you've been working with them in partnership for as long as we have, better part of 2 decades, you also learn some of the more nuanced and subtle details. We talk about these banks, whether choose your bank, whether it's Citibank or Deutsche Bank, Santander, whoever, they're not like one decision maker. Often, if you handle the relationship well, you as the asset manager can almost be called in as the adult in the room to mediate between some of the folks who want to just sort of put money to work and over leverage and agree to lower covenants, and those who want to show more discipline. And again, it applies more in Europe than the US because I think the lenders have more market power. That's why we're devoting so much time to Europe these days. But the number of times we've been called in to say, basically, because the bank didn't have enough sort of fiscal discipline to hold tough on a covenant or some pricing, we were used as sort of the bad parent to enforce that. So let's remember, just like I said, US is different than Europe. Let's not treat these banks, these are 200,000 person organizations with their own set of politics. And that's where in your handbook, being that mediator or moderator can, be helpful to the bank, but also helpful in the end to get the best risk adjusted.
Yeah, I don't disagree. When they try to compete on a 5.5 turns unitranche, they're making a mistake. When they're leveraging their huge networks and relationships and their bank products and all these things that are great, fee-generating return on equity trades and partnering with people in a smart way to do it, that's great. I think a lot of the headline partnerships are just that, they're headlines. You're not going to see a lot of
what we do is the first stuff you mentioned, and I think that's what
totally. There's a huge opportunity there. And
we can write the handbook together and we can deliver.
There you go. Disagreement's good. Makes for a good panel. So Rudy, last stage setting question, and then I know the audience is as anxious as I am to hear about how you're approaching and dealing with current state. At face value, you might look at insurance and a private credit GP or platform as strange bedfellows, right? But the reality is I've learned more about both you and your contemporaries and the way they've thought about these two businesses living together, coexisting together. It's similar to the way Warren Buffett talks about why I bought Geico, because all this float comes in, and then you have this capital ability to invest, and in your case, create origination platforms. And as long as the ALM matching is still okay. So can you kind of talk us through the strategic relevance and insight into why they should live together, and then two, how you make sure you don't mess with the purity of the insurance business?
Yep. You're setting me up for all these relationship comments. It's amazing. So, strange bedfellows. You should see my wife. Beautiful, witty, charming, perfect complement to, I guess, me. But if you think about private credit and insurance and the way that the markets work, fundamentally for an insurance company, what you're doing is you're making small promises or promises to individuals that you will return their capital, especially for the businesses that we invest into, where we're dealing with retirement income solutions. So these are individuals that have taken, a small chunk of their paycheck for a long part of their life, put it into their 401ks, and then they're ready to turn it into a retirement income stream. Our biggest responsibility is to match our obligation of cash flows to them over time. And the best way to do that is to step into positions where you're being paid more for the risk than you're taking. And so if you think about the private credit marketplace, forget about the wrapper we put onto things, because you could call it private credit, you could call it BSL, you could call it whatever you want. These are all terms that we come up with to make ourselves feel better at night, to justify the divisions that exist within various banks or other organizations. What we're doing is fundamentally taking on risk. And so if you think about the risk associated with the underlying companies we're investing into, they are typically below investment grade, they're typically private, they're typically held by, either a founder or a sponsor who's put real equity into the business. Leverage levels have actually gone down over time as you look at the overall value of these businesses. And we're sitting in the most secure position at the very top of the capital stack with a first lien on all of the assets and the underlying business with cash flow traps, appropriate documentation in place if we do our job properly. So we're actually doing the right thing for the underlying policyholders and annuitants by getting into this market. Forget about the names that people are talking about. Are we doing the right thing as risk managers? And from an insurance company perspective, this is why I was making the point about banks earlier. We are holding that risk for as long as we're in the position. We have to own it, we have to manage it, and we have to make sure that we are comfortable going to sleep at night with the risk we have in our balance sheet. And so with private credit, the way it's defined today, I think it's the perfect bedfellow for an insurance company. It's done well for our friends at Apollo, it's done well for our friends at KKR, and frankly for the team that we picked up and started with about 2 years ago, they've put out several $billions of capital, and within the first year, they've returned over $250 million with a north of 20% IRR. So you're getting private equity type returns for a first lien, senior secured position in private credit. Why wouldn't an insurance company sign up for that? It makes all the sense to me.
Yeah.
Well, insurance, I mean, the other institutions, the whole thing of private credit, and you see the headlines about all the risk about private credit's grown and what's going to bubble and all this stuff, and it's like the capital's moved into the pocket that actually wants to hold it, right? The middleman isn't as involved as he used to be, and when you're investing for your own book, as in case insurance or these institutions that you meet on the fundraising trail, like they're doing real work, right? They're choosing their manager with a lot of thought and a lot of data room access, and they're doing their work. And so it's ending up in the pocket that wants to hold it, and it's being underwritten by someone that has a vested interest in making sure the document is appropriate versus a middleman who doesn't really care what's in that document.
Yeah. So I want to jump to current state, kind of masterclass over on how we got here. Michaela, I thought, particularly from your perch at the top of the value chain here as a capital allocator, anytime we talk about things like golden age or hyper growth, right, everybody should ask a question, take a breath, right? And I think capital allocators are best positioned to do that. So typically in history, what happens when interest rates pop and you've had significant fundraising and a whole lot of dry powder and a lot of new GP entrants is that underwriting standards start to weaken a little bit around the edges, that these books maybe are not as strong or as healthy as they otherwise would be. How are you kind of assessing, diagnosing the books of your partners and others, and what should we be thinking about in an environment like this in the cycle?
So the reality is that if you look at, going back to my previous comment about being a relative value investor and not being a fund that raised just for private credit, we also are in the position where if the market doesn't provide us the risk rewards that we believe it's needed in order to underwrite a certain credit, we can play either on the public book or on the macro. And in the current volatility, you find yourself sometimes being paying more to all gilts than, for instance, to buy Apple. So why would you buy credit when you can stay cash and liquid for the same price? So what happened over the past couple of years, and given the volatility, is that sometimes we found ourselves short credit compared to where you would like to be, and you wait for the opportunity to deploy. When it comes to deploying in private credit, I think, as I said before, it's fundamental the underwriting standard that you apply, and that you don't loosen your underwriting standard just because spreads get tighter, or you start losing transactions, because then the quality of your book may actually deteriorate. So we found ourselves sometimes losing transactions or losing potential opportunity. And by private credit, to be fair, I should be very clear that I talk about private credit, but we don't play in the distress and non-IG space, because under the Solvency II, it just cost us too much to hold non-investment grade. Again, with Solvency II reform, there are opportunities potentially to start looking at lower capitals, lower rating. But actually, in the time like this, what we found is that, particularly in the public market rather than the private, but you try to actually take the opportunity to make your book more resilient, because the spread difference between triple Bs and single A are not that much. So there are opportunities to optimize and make your portfolio actually credit better from a credit strength perspective. And again, when it comes to private, I think what we had to do is basically to start looking at potential new asset classes and ensuring that you have the right approval internally to be competitive and being able to take opportunities in new asset classes. Of course, you probably all know if you play in infrastructure, you probably have been priced out multiple times because it's very competitive. When you start to be able to look at more complex transactions and have the skills internally to underwrite more complexity, it gives you a bit of edge in terms of competitive advantage and in terms of creating more risk reward and more, you're getting a bit more paid for the risk you're taking. And so the development of new assets for us, looking at CLOs that I know that for everyone, particularly if you come from the GFC, et cetera, it's a very known way to invest in CLOs. Again, as I said before, for insurance company, at least in the UK, under the matching adjustment and Solvency II, we were not friendly structure. We just, from a regulatory perspective, couldn't look into that. And now, again, thanks to the evolution of the regulation, we start to get closer to potentially looking into CLOs, and we are quite excited about it because it provides you yet another diversification and also exposure to mid-market that tends to be non-investment grade, where we can play directly because, again, we need more of investment grade type of assets.
Paul, I want to come back, as I promised, to this idea of glutton for punishment, because while I've got less hair than you, I think you've got 1.5 more crises under your belt than I do. So you joined, this is just shocking, somewhat amusing, I hope, in retrospect, but you joined the Fed, I think, just before, as I recall, the S&L crisis. That's and right. Then I caught the tail end of the next one, the peso crisis, and then felt smart for a year until Asia. Yeah. And then, of course, we had .com, and then we had GFC. So you come at this with maybe a bit more scars, certainly more objectivity than perhaps a lot of the GPs, as I alluded to earlier, that have launched post-GFC. So objectively, Paul, I know you're structurally bullish on this business, but objectively, what are some of the things you're watching for and maybe throwing up yellow flags on?
Well, yeah, scars for sure. I still have hair, although it's grayer than it used to be. But I definitely put on sort of 10 or 20 or 30 kilos each time one of these crises happened. So I don't know about you, but when we sat into these chairs, like I almost have to like fight my way out of them. But I am structurally bullish on what's happening right now. But I'm gonna get some third-party validation. I want to build on a comment that I heard I'm not going to try to pronounce her name, but the current head of the World Bank, IMF, made yesterday. She said, not only does the uncertainty allow for the opportunistic to turn the uncertainty into an opportunity. That's what we're all supposed to say, and in fact, we very much believe. In fact, I founded Orchard on that principle, probably because I had been sort of slapped around by so many financial crises. But she said something that I think we should all listen very carefully to. She said, this uncertainty is actually causing opportunity. She used, as I have often used, the analogy, and Besant said it a little bit, of NATO and defense. For decades, the Germans and the Europeans are saying, oh, we can't pay for our defense, we can't pay for our defense. The US, you should pay for our defense. Well, Donald Trump says some nasty stuff, and I was actually in the room when J.D. Vance gave that speech at the Munich Security Conference. The speech was kind of what J.D. Vance does, but the look of horror on the faces of everybody, you would first say, oh my God, this is the end of the world, NATO is over, the Russians are gonna overrun. Guess what? Within a week, von der Leyen, the European Council president, magically, 800 billion is going to be pledged on defense. And then a week later, the Germans, with their newly elected government, changed their constitution, and now they're spending 500 billion. Her point was this, is the adversity is causing people, or dare I say, allowing politicians to do what they knew that they needed to do, but weren't doing. And so the adversity causes that. And I see the same thing, and we saw it in we saw those patterns in the savings and loan crisis and in the dot-com crisis and in Asia. You know, the Asian financial crisis forced some tough decisions to create the Asian boom, and that's exactly what I think is happening now. And that's why we are structurally bullish. Now, that doesn't mean you just sort of, you know, force sails to the wind and just go for it and roll the dice, but rather, let's not get too bummed out by the surveys that we're seeing. There are structural reforms that are happening in Germany and Europe now that were not even being talked about 2 or 3 months ago. And that's where, you know, working with your favorite banking partner, you can choose and navigate. So yellow flags for sure. It isn't all just blind golden age, but in the opposite, green flags, look for those people who are using the excuse of this I don't even want to call it a crisis, this situation, to actually put their house in order and start doing the things that A, will help them and their citizens have better lives, but B, will allow us to have better risk-adjusted returns.
Yeah, and on the private credit side, like I'm thinking back to my first decade in this business, kind of led up to the Great Recession. And it was kind of on the back of how our portfolio performed out of that we say, you know, we should raise dedicated funds for private credit because it performed so well. But when you think about the 07 deals, 06, 07 deals getting done, interest rates were lower, the margin was lower, and debt was really paying for the EV as it went up. And so leverage levels were going to 6 and to 7 and 8, and, you know, Univision was, you know, 10. And then you fast forward to right now, and interest rates have put a cap on where leverage can go. And Rudy alluded to it earlier, that leverage has actually come down in books over this period of time. So we're at a position now where, like, I like the way we sit as an asset class, because we're rough math. If you're talking about the guys doing first lien lending, which I think most of what we've been referring to is, you're at about a 40% loan to value, right? You got 60 points to be wrong. So tell me the value's too high. Sure, I agree with you, but chop a couple multiples off. We still have good cushion. And then you start thinking about that negotiation, if you're willing to negotiate, which is a whole different topic about what the big boys are willing to do or not do to protect their relationships. But if you're willing to, if you have the will to take action, you have currency to play with, because you're soaking up all of the cash flow from the business and interest, and you can use that to restructure a business if you choose to. Yeah. So as an asset class, I feel like leverage hasn't been pushed as high as it has in past crisis or cycles. And you have this income, this cash flow that you can use to negotiate your way out of it.
So let me just press on that a little bit further, because I think dislocation is the friend of agile capital, right? Mm-hmm. And private capital really is the poster child of agile capital. In a normal cyclical cycle, I understand everything you're saying. When you throw in the uncertainty that markets hate, you know, we can handle right and left, we can handle disagreement and agreement of policies and approaches to geopolitics, trade, tariffs. When you throw in the lack of understanding of a ballast of where we're going, the markets get shaken a little bit. So how should we be thinking about the agile capital when there's a lot of unknowns from kind of relationships with other countries, and how capitals will flow between Europe, Asia, the US, and what's happening in politics specifically, Joe?
Well, I think one thing is, like, when you think about on the upper end of the market, all the deals that have been done and how big those portfolios are, like, do they have the skill set to manage through that, or the will to manage through it? We see a lot of kicking the can, right? It keeps the sponsors happy, it keeps the BDC market happy, and so, you know, those problems probably get worse, but fine, you know, enterprise value probably grows. So one is, are you willing, and do you have the manpower to deal with that? The nice thing about this, for those of us that haven't just, you know, raised capital with abandon, is it rewards discipline. It rewards underwriting, and then it opens you up. If you're not stuck on dealing with the problems in your portfolio, then wow, there's a huge opportunity set. It's always been by far the dollars we put out tends to double in times of uncertainty, in times of dislocation, right? So that just tells you how dramatic the opportunity set is that grows. Borrowers have less options, right? They need people that have capital that can move. You even saw it briefly even in COVID, right? The guys who were dealing with They didn't know all the revolvers were going to get funded, and their leverage, they were sideways with their banks, and they were dealing with those problems. They weren't putting loans out. We were able to step into a lot of interesting opportunities. I don't think, like you look through the private credit portfolios right now, I think they're pretty well protected by and large from tariff impact, first order impact, right? Maybe there's some Medicaid, probably, if you're thinking broader policy, there's probably some Medicaid that people need to deal with, but it's really the CapEx that's not getting spent. It's the hiring that's not being made, and I don't know, what's that take to, get through the markets 6 months, a year, 2 years from now. I think we'll be talking about, oh, this is what caused it. That's what the uncertainty caused. I don't see it, at least right this instant, in most companies in our space. And, most of the, if you look at the big guys, it's software, business services, and healthcare, right? Like, there's some importing and all that, but if you didn't see the writing on the wall with President Trump on the campaign trail, then shame on you.
Yeah. By the way, audience, as we're headed towards below 10 minutes, please submit questions. I will work them in as they float through the iPad here. So a couple of you in the prep session talked about AI and the practice and the implementation of utilizing AI and how you think about, I assume, both your own business and your portfolio companies. Rudy, maybe I'll start with you and how you've thought about this and how you've executed and demonstrated this through your books.
Sure. So going back to a theme that we've touched on multiple times here, having information associated with your underlying businesses puts you in a better position to be able to execute if and when things go sideways. So if you don't understand your business's exposure to certain geographic markets, to certain geopolitical events, you're going to be left with a blind spot. That's going to create a problem for you that you haven't accounted for. Now, people say, what is it that's an issue in the marketplace? It's not the things you don't know, because nobody knows that in the marketplace. It's not the things that you know are a problem, because you'll mitigate that risk. It's the things that you know for certain. And so when you assume that something is going to happen in a specific way, and you don't validate that, you end up in a very unique position where all the assumptions you've made turn out to be wrong. And so using AI, using technology, getting a diversity of data as quickly as possible, because we've touched on this theme a bit. How do you actually get to a place where you can execute appropriately and be that agile, nimble capital? The way that our team works is we provide certainty of execution. How do we provide certainty of execution in a way that we feel comfortable with the risk we're taking? It's by having a better technological perspective associated with the underlying business. That means we look at more data sources, we understand what happens with the business in various scenarios, we plan around what could happen with an interest rate spike, what could happen with tariffs going into effect, what could happen if customer concentration shifts, and we look at that granular data to understand how the business actually works. So we've used outsourced technology, meaning people who work around the clock when we're not. We've used third-party data sources, and we're spending the money up front to get to the right answer, because you never want to be in a position where you go to an investor and say, I could have spent an extra $300,000 on XYZ technology, but I didn't do that, and instead I took a $50 million loss in the portfolio. That's a horrific risk-reward analysis. So what we're seeing is that the innovation that's coming in the market with ChatGPT, with OpenAI, with other platforms, even Microsoft Copilot, which is a version of OpenAI, you can now take reams and reams of data, assimilate it very quickly, come up with a perspective, as long as that base data is accurate, and then you can have an informed perspective rather quickly on what's happening with your underlying businesses. And from there, you can take that information and turn it into scenario planning for all the various outcomes that we're talking about here, which gets to sensitivity around the ability to repay, especially for the first lien lenders. I think people who don't have technology in place in the next 3 to 5 years won't be in the marketplace. They're just not going to be able to compete, because they're not going to be able to get a deal done, and they're not going to be able to figure out what the risk is with the underlying company that they're investing into.
Others on AI or specific segments you're excited about?
So I agree that you absolutely need to use all the tools, as you've articulated, to help manage your portfolios better. I think that's common sense, and I do think the ones who adopt it will be the winners, and the ones who don't. But at least for the next, 3 to 5 years, I think on this panel, we should, or at least we at Orchard, have a little bit different take on AI. We're lenders. We're senior secured, old school lenders. We're not a VC picking this versus that, so we're not going to have that one 50x to pay for the other sort of mistakes that we made. And so as we saw this, and it really started even before AI, but as we meditated, how as lenders are we going to take advantage of that? Rather than picking, I don't know, OpenAI versus ChatGPT or this or that, we're like, where can we get paid supernormal returns? And that really comes down to us, and Besson said this a little bit, but I want to build on it. The country or companies, the people who are going to win the AI digital dominance are going to be the ones who have the best infrastructure and the best energy and digital infrastructure to be able to deliver that. I mean, literally they're talking about, right now it's institutional electricity in the US, in Virginia, where a lot of the data centers are, is about 8 cents per kilowatt hour. It's 40 in Germany, and it's whatever it is in between those two in China. If we can, as a country, as a national strategy, through drilling more in Texas and New Mexico, if we can win the energy dominance, then we can win the digital dominance. So how can we as lenders take advantage of that national strategy? So for us, the best AI strategy is we're doing a lot more energy infrastructure lending, a lot more data centers, we're not the only ones. There's more money that is being spent on the storage and transportation of data that was spent in the 10 years previous on the drilling and transportation of energy. So it's not a fancy answer. We're not picking the winners and losers, but we can, as lenders, make a heck of a lot of money getting paid supernormal returns for making sure that we're helping lend to the infrastructure that allows for this, that, or the other winner to win.
Yeah, and the only thing I'd add is all that's helpful, and it's a tool, and there's ways to invest around it, but at the end of the day, we're talking about first lien bank debt here. We're not trying to mine asteroids for metals. Like, you show up in the office.
Not yet.
You see the management team face to face, you ask them uncomfortable questions, and that's how you're gonna get the answer. Technology gets you so far, might help you source the opportunity, might help you risk analysis, your portfolio, but you gotta show up. You gotta be the person.
I don't disagree to what you say. I think it's like, I'm a credit analyst and I don't think my job is going to become obsolete, but AI is not an option in terms of productivity. So to go back to Rudy, in the sense that it's going to be, even in workflow, workforce planning and strategic workforce thinking through the next 5 years, how fast your workforce actually implement AI and technology will result in more productivity, meaning that your people can meet more borrowers rather than writing credit paper. And that I think it's going to be important on top of the opportunity in terms of the digitalization and therefore the investment opportunity that AI will create. But I don't think it's almost anymore a question what you do with AI. You need to embed it and to make it part of your workforce planning. Sorry.
Joe, so we've got a question back to you. When I was asking you to segment between some of the broadly syndicated loans and some of the smaller, more nimble players. We could do another hour on the evolution of secondaries, but the good question was, how is the introduction of secondaries away from kind of the old days of, you pull the ripcord, it was a desperation attempt is how they were used. Now it's a real portfolio construction tool. How has that changed the business?
I think it's good. I think it gives LPs a lot of options, and it gives them liquidity. Now, they pay for it, right? Because it's an illiquid asset class, so you're going to take a discount, but there's so much secondary activity popping up that I think that margin, what was a 10-point discount, is going to compress, just like any other market where there's competition. So I think it gives LPs a lot of flexibility on choosing where to allocate or shifting allocations. Like right now, as they see, like, man, am I worried about this? Do I think there's another way to play it? You now have an option to do that, whereas before you probably sat there and said, well, I'll wait till this runs off, and then the next time you raise capital 4 years from now, I'll come talk to you. Now it can be pretty real time, which I would think is pretty powerful for them. I don't think it should impact our market a whole lot, and I don't think I'm not a huge believer in a big distressed opportunity of private credit guys being willing to sell their mistakes. I just don't see that happening. I think they're going to, based on my experience, they're going to, as I said, kick the can, hide it. You're going to see percent PIK go up. That should be your first warning sign. You're going to see people handing out delayed draw term loans. and telling the company to pay interest with them, that's like the most disingenuous thing I've ever seen. But that's tools that creative people are going to use to preserve optionality.
Well, you said it helps LPs, and you're right, but it actually helps investors as well. For those of us who are not in our day job, sit on, endowment boards and such like, yes, the biggest, I don't know, the Harvards and the New Yorks and the CalPERS, they've been there. But if you are that 100 million to 2 billion who wants to start, or 5 billion endowment that wants to start playing in this, you really don't have the time or patience to start a program now that may or may not yield something because of the J curve in 10 or 11 years. That secondary market can be a way for the smaller people to get in. So, look, it's like you said, rational actors. Markets exist when there's a buyer and a seller. If LPs have more options, should they need to sell, fine. But if there's smaller LPs, want to get in because it's a way for them to get in, a half a decade to a decade earlier, well, that's what creates a market. And I do agree that 10-point discount in our space is probably going to go to, I don't know, 1, 2, or 3. So it really helps both sides.
It accelerates the pace tremendously, especially when the data suggests the average tenure of a CIO is 4.5 years. You don't want to wait 12 years to get your allocation. We're sadly going to have to end it there. Let's give this panel a great round of applause. Thanks for your attention.
We hope you enjoyed the discussion. Please make your way to your next session.